Hello and welcome to this video on taxation. So in this video we're going to look at different types of tax and tax system and the Laffer curve theory. So let's start off with a quick reminder of what are the objectives of tax. Well, as we know, tax is part of fiscal policy as a way of managing the economy. Tax can also raise money that the government can use to finance public expenditure, for example, providing defence and security services. Tax can be used to redistribute income. It can also be used to internalise external costs. We would tax tobacco and alcohol. And to influence the pattern of expenditure, we can try and switch people's spending from one product to another product. There are two main forms of tax, direct and indirect. Direct tax is applied directly on an individual organisation and usually applied to some form of income, for example, personal income tax, or if you're a business, it's applied to profits and corporation tax. Indirect taxes, on the other hand, are only applied to the consumption of a good or service, not your income. And we have two types of indirect tax. A specific tax, so this is a tax that a set amount applied per unit, so for example 5p tax on a bar of chocolate, or an ad valorem tax, and this is where a percentage is added to the price. So for example, value added tax of 20% would be added onto the price of a car. So let's look at the main taxes that we get in the economy. Here is the breakdown of UK tax receipts. If we go down in order, we can see the bulk of the tax comes from income tax. This second one is another form of tax called national insurance contributions, and that's used specifically to pay for things like healthcare and pensions. Then we have the value added tax, the tax on fuel, and that's really the main bulk of the taxes. We can see there are other indirect taxes here, other taxes applied to the consumption of particular products. Then quite low down, compare this perhaps with income tax, we have corporation tax. Then we have council taxes, a local government tax applied to households. We also have a local government tax applied to businesses. Capital taxes, so if you buy or sell shares or property, you often have to pay a tax on the capital value. And there are a host of other taxes that we might consider. When we talk about different tax systems, we often talk about them being either proportional, regressive, or progressive. So let's start off with the proportional one. What we have here along the bottom is the tax base. So effectively, you can almost imagine this as earnings. So at this end, we have people who earn very little, low earnings, and at this end, we have people who earn a lot. And on this axis here, we have the total amount of tax paid. And we can see from the shape here what's happening to the amount of tax paid as your income grows. So as your income grows to the right, what's happening to the amount of tax paid? Are we paying increasingly more, proportionally the same amount, or paying proportionally less as incomes rise? So let's start off with what we mean by a proportional tax, the one in the middle. A proportional tax system means that the proportion of tax paid remains constant in line with incomes. So perhaps you pay 20% of your income as tax if you're a low earner. You would also pay 20% of your income as tax as a high earner, and that includes all the taxes, direct and indirect. A progressive tax system means that the proportion of tax paid increases as incomes increase. So we can see that here, as incomes start to rise, the tax we're paying is increasing. So a high tax earner is going to pay a greater percentage of their income as tax than a low tax earner. The final type of system is a regressive system, and this means that the proportion of our income that we pay as tax falls as our income rises. So here we have a low earner is paying this amount compared to their income. When we have a high earner, they've obviously earned a lot more, but the amount they pay in tax actually hasn't gone up by very much. So they're paying less of their income as tax as a proportion. The key here to note is it's always a proportion of income. It's not the absolute amount of tax that's being paid. It's the amount of tax being paid compared to our incomes. Okay, let's have a look at this again, but with a numerical example. So here we have three people with different incomes, a $10,000 earner, $50,000 earner, a $100,000 earner. Let's see how much tax they might pay under these different systems. First of all, if we start with the proportional system, we can see that this first person is paying across all the taxes $1,000, which is 10% of their income. This person here is paying $5,000 in all taxes, which is again 10% of their income, and this one is 10% of their income. So here, all three individuals are paying proportionally the same amount of tax, 10% of their income. A progressive tax system might look like this. The low earner is paying here a 0% rate of tax. As we go up in earnings to 50,000, this person is paying a 10% rate of tax. As we go up again to the 100,000 earner, this person is now paying 40% of tax. So the percentage tax rate has increased as earnings have grown. This is a progressive system. And finally, we have a regressive system. This first earner paying 1,000 is paying a 10% tax rate, $1,000 out of their income of 10,000. This next person, importantly, is paying more tax, but they're only paying a 5% tax rate, $2,500 out of 50,000. Again, this high income earner is again paying more tax than previously, but this is only a 4% rate of tax. So the rate of tax has gone 10%, 5%, 4%. We would say this is a regressive system, even though each time more tax is being paid. So just to summarize, this is a good diagram to take down in your notes. As incomes rise under a progressive system, we proportionally pay more tax. Under a proportional system, we keep paying the same rate. Under a regressive system, we pay less. Most tax systems around the world are regressive at low incomes and then become more progressive at high incomes. An economist who looked into this a lot was an economist called Laffer, and he came up with this idea that we have an optimal tax rate, T star here. And his theory went that as we increase rates of tax, then the government earns more tax revenue. But there comes a point where actually, as you keep on raising the point of tax, people go, what is the point in working? Why should I work so hard? Why should I even live here? Why should I pay tax here? And actually you put taxes up so high that actually government tax revenues start to decrease. And so the question is really, what is this optimal rate of tax for an economy that maximizes tax revenue? So the question is really, what is that optimal rate of tax? What is that rate of tax that will maximize tax revenues? So there's a few different points of view. A lot of study has gone into this, and we have some conflicting results. This chart here is a summary of some analysis that was done that looks at what happens when you change the marginal tax rate, the top marginal tax rate, so that the tax rate that's paid by the highest earners. And it compared that by looking at real GDP growth. And what you can see, if we look at a kind of a rough line of best fit here, is that as we cut top rates of tax, this analysis would suggest that we get slightly higher rates of economic growth. When we increase tax or we don't cut taxes, then we tend to get slightly lower rates of economic growth. On the other side, this analysis here is looking at changes in real GDP growth, and it actually concludes that the maximum rate of tax you can go to is about 67% top rate of tax before you start to see a decline in economic growth. It would suggest that anything below about 35% rate of tax actually would be correlated with negative economic growth. Some countries use this idea of proportional tax rate or a flat tax rate on personal income. So these countries here just have one standard income tax rate. They don't operate regressive or progressive systems. So when we're looking at analysing tax, we have to consider some things. Obviously, tax is a withdrawal from the circular flow of income, and so the greater the rate of tax, the lower the multiplier effect in the economy. We have to think about the impact of tax in relation to price elasticity of demand. More price inelastic demand for products means that tax will have less of an effect on people's spending habits. We can also consider the incidence of tax. We consider the use of tax to deal with negative externalities. Taxes might lead to cost-push inflation. Taxes distort the functioning of the price mechanism. Tax have an effect on income distribution. Taxes have an important impact on the incentive to work. Taxes obviously have an impact on government's budget position, and generally speaking on the level of economic activity. So tax is a very good thing to think about widely when we're looking at this issue in Unit 4. So in this video we've looked at different types of tax and tax system and the Laffer curve theory. That's it. Thanks very much for listening.